What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Ivanovich. I am the host of the pod. I'm a trader slash investor at Spoonbill Partners LLC. I trade stocks, bonds, derivative products, private public markets, you name it, and we've probably traded it. So we have a bit of an interesting episode today. There has been no shortage of things going on in the tape. It's been a tumultuous 2 weeks to say the least. And in this pod episode, I sort of wanted to not backtrack, but address some things I've said in the past, provide a little more context. I want to address a couple of new things. And in this episode, we're going to try something a little new. I'm not typically big on putting graphics in the episode, but I think it might be engaging. It might help illustrate some of the concepts I'm talking about, especially since they can be abstract if you're not particularly well versed in things to do with financial markets. So hopefully that helps some of the viewers understand some of the crazy things that I say every now and then. So without further ado, we're going to jump right into the show. We've got 4 exciting segments today, and we're going to start off with memory. Memory has been a big topic. Obviously, if you've watched the Korean stock market, the Korean stock market has had this epic run this year because of Samsung and SKHY, who's now doing a US listing that's supposed to come public on Friday. Memory stocks in the US like Micron, SanDisk, Western Dig, Seagate, there's a few of them, have also seen some really epic runs in their price so far this year. Now, in the last 2 weeks, like I said earlier, it's been a tumultuous 2 weeks, specifically for the semiconductor complex, and memory names have really come in off their highs. Like I've talked about in previous episodes, things I think just got a little hot. There was a couple of negative data points here and there. Samsung reported a blowout quarter, but it just wasn't enough for extremely elevated investor expectations. That caused the Korean stock market to nosedive, and by proxy, a lot of the other memory names in the US took a beating as well. So I know we've discussed this in depth before, but sort of the whole bull debate, the whole bull thesis, and why these names have experienced this crazy run up, it all rests on this one idea of, is memory a cyclical business or is memory a growth business? It all rests on this one sentence. Is it going to be different this time? Because memory historically has always been a cyclical business. But since AI models have become a big thing, and when you build a data center, you obviously have your GPUs and your CPUs that take on a lot of the workload, but in order to execute tasks, you need to have memory attached into the GPUs and CPUs. And standard memory doesn't really do that effectively. So these companies have created this new memory, SRAM, and there are a few other types that we've discussed in the past where you stack on top of each other DRAM chips. And because of the crazy amount of capex that is going on right now and the colossal amounts of money being poured into building out as many data centers as possible, these memory stocks are receiving unprecedented demand. They have never seen demand at this scale. They have tons of long-term agreements. There are orders going out to 2030, 2031. There's a huge backlog, and Samsung, Micron, various other companies have announced that they are going to try to bring capacity online. And basically what that means is they're going to try and build out factories to catch up with demand so that they can fulfill more orders and make more money. Now, this is where the little asterisk comes into play. Typically when this occurs, when you see this crazy amount of demand for a product, and then the company's like, shoot, we need to capitalize on this, the company's first instinct is, we got to raise money or use existing funds to build out more factories, to deliver more product to customers, because the demand exists. Now, what occurs in a cyclical business is that happens, and once the supply is built out, i.e. the capacity is built out and the supply is able to meet the demand, the company providing the supply no longer has pricing power. When demand is up here and supply is down here, everyone wants to buy. And so this company can charge whatever they want because there's always going to be buyers. But as you supply more and that supply meets the demand, and if you add too much capacity and there's too much supply, you don't have enough buyers, and so you lose your pricing power. So I think everyone sort of understands that. Now let's get into some of the nuance of what's been going on this week. As of this week, Micron, Samsung, SK Hynix, and the Roundhill Memory ETF are all down more than 20% from their highs. Looking just outside of memory, semiconductors as a whole have lost about $1.5 trillion in value since June 25th. That was roughly 2 weeks ago. And Micron alone lost close to $350 billion in market cap. So I mentioned earlier that there was a couple of negative data points that sort of contributed to this. The first one being the July 6th trigger. On July 6th, there was a Bloomberg report that got sent around that Apple is in talks to buy memory from CXMT and YMTC. These are two Chinese companies that produce memory. On that day, SK Hynix dropped 15%, Samsung dropped 9%, Micron dropped 5%. And the reason why this is such a negative is because, earlier when I was doing the crazy thing with my hands about the supply and the demand, Apple announced recently that they're going to have to hike the prices on their products a significant amount just because of how expensive input costs have become, specifically memory input costs. They don't want to really do that because hiking prices that much, I think on some products it was as much as 20%, is going to cause some demand destruction. You might see iPhone sales take a dip, MacBook sales take a dip. So when the entire bull thesis is predicated on a few companies having unlimited pricing power and there's very limited supply, well, now all of a sudden there's this fourth player in the tape, which is China, with these two companies that produce memory. And so if Apple, one of the biggest buyers of memory in the world, is now negotiating with China to purchase memory from them to get it at a cheaper price, well, that spells pretty bad things in the future for all these other companies I've mentioned before. And I mentioned very briefly earlier the Samsung report, just to give you a couple of numbers. So on Samsung's report, it was a monster quarter. Nobody can argue that it was an incredible quarter. Estimates of $59 billion in operating profit on $113 billion in sales. That's a 19x year-over-year profit surge that even beat expectations. And the stock got hit anyway. I think it closed down 8% or 9%, something like that. So in other words, when a company has a quarter as good as this one, an impeccable quarter, and the stock trades down almost double-digit percent, the market is telling you something. It's a sell the news event. The good news is already in the price. So when we got that news that, oh gosh, it was the best quarter on planet Earth, and the stock gets hit like that, selling the best news ever is classic top behavior, and certainly not the start of something brand new. So I told you I'm going to put some graphs on the screen. This is going to be the first one. I don't know where exactly it's going to be, but it's going to be somewhere in the middle of the screen, so you won't see my pretty face for a while. Probably not a terrible thing. So basically what this graph shows you, earnings and the price to earnings multiple move in opposite directions. So peak earnings times a low multiple, the stock looks cheap, and that's the top. Trough earnings multiplied by a high multiple, look expensive, and that's the bottom. In other words, a low price to earnings on a memory stock is not a bargain. The market deliberately shrinks the multiple exactly when it knows earnings are about to roll over. So if this is truly a growth story and the step change is real, the new supply coming online gets absorbed and the re-rating holds. If it's just the old cycle wearing this, silly AI costume, that same wave of supply is what's going to break pricing, and the multiple compression is going to be brutal, especially since we've seen an incredible run up in some of these memory names. Micron's most recent quarter posted something like 84% gross margins, up from 37% the year prior. That obviously is going to attract the idea that we need to bring capacity online. This is a profitable, very profitable business. It's an open invitation for everyone. It's a capacity adding party. And that exactly is how a supply glut is born. Eventually, the demand is going to wear off and you will be oversupplied. The pricing power will be gone. Multiples will contract aggressively. That's sort of the bear thinking. And I've done a lot of bear talking. I want to point out some of the points made by the bull camp and why I sort of disagree with them. The first one being there are obviously multi-year hyperscaler long-term contracts that give unprecedented visibility. Well, I would say this: contracts don't repeal demand destruction. If smartphone sales are set to drop 14% this year, which is sort of the estimate, and PC unit sales are shrinking. If even one hyperscaler decides to cut CapEx in one of these next 3 quarters before 2026 is up, the sold out through 2026, 27, 28, 29, 30 narrative now it flips on its head and becomes the renegotiation narrative. How do we get out of these LTAs? And the day you even hear a whisper of that is going to be some carnage in that market. And I'm not trying to fear monger or anything like that, but it's a very real risk that you need to be aware of. The second bull, case or bull point would be AI demand is structural and not cyclical. I get it. AI is a incredible technology. I use it every day. All of my friends use it every day. It's very, very helpful. The agent thing that Claude is doing is very interesting. There are so many ways you can lever AI, but cloud is also extremely helpful. We all use the cloud. Solid state drives are very useful. We're very important for the technology boom. Smartphones, extremely useful, and we all have one in our pocket. And if you don't, I envy you. Each of these things felt permanent and like it was going to last forever, and all of them ended the same way. Do we still use them today? Yes, but the multiples eventually contracted as the market became mature. And the last thing, which is sort of I think a bit of a trader's point, something I've picked up on in the past. And maybe a lot of the pundits are not going to point to this because they think it's sort of a cheap signal, but I don't think it's such a cheap signal. The sell side is unanimously bullish. I don't think there's a single sell side shop out there, or maybe one or two here or there, that is bearish on memory. And that to me, there's an old adage on Wall Street and just in trading in general, when your barber is telling you about a stock, you need to sell that thing as fast as you can. And I heard that when Bitcoin went on its extreme run. I heard that when Nvidia went on its extreme run. Every super hyped up, amped up stock, when people who are not really involved in the market start to tell you about things like this, that's usually a sign of the top. It's not a great indicator, but it is something to pay attention to. When the exuberance exceeds what is realistic, you're in a precarious position. So could I be wrong? I could 100% be wrong. This is not me telling you to go and short any stock or go buy any stock. As I've said so many times on this show, I don't give any sort of picks like that or any sort of financial advice like that. I could 100% be wrong. Could the demand outstrip supply for years to come? It definitely could. I'm just saying history doesn't repeat itself, it always rhymes. And I think it would be irresponsible if you didn't study the history of memory. And I think it would also be responsible if you used the words "this time is different," because countless times in the stock market over the course of history, people have said the scary words, "this time is different," and they have been hurt very badly. So that's all I want to say on memory. I don't personally believe it's going to be a multi-year growth story. I think at some point the supply will catch up with demand and you will see multiples compress and these stocks will return to where they were 6, 7, 8, 9, even a year ago. Let's move on to segment number 2. This is not one I'm going to spend a whole lot of time on, but I was reading a piece that came from Mizuho. And they had a graph. They talked about a lot of things in the piece, but there was one specific section that had this graph that really just caught my eye and reminded me about the beauty of macroeconomics. It was a time series graph that showed, I think it was like 20 or 30 years, and then it plotted various different sectors of the economy. It was just tracking the US, but various different sectors of the economy and how much inflation on average each sector has experienced from T0 all the way to T20, let's say period of 20 years. I don't remember the exact graph. Actually, I'm going to put it right here. I'll go find it. You'll be able to look at it here and understand what I'm saying. So as you can see, every line moving higher is a sector that is soaked in government involvement. So subsidies, heavy regulation, third-party payments, or insurance or government, healthcare, higher ed, childcare, housing, all these sorts of things. Every line heading down is a competitive, lightly regulated, globally traded, tech-driven, things like electronics, toys, software, apparel. The mechanism in plain words that's at work here, when the government subsidizes demand without expanding the supply, think about student loans, Medicare, Medicaid, child care credits, you're just handing buyers more money to bid up a fixed amount of stuff. The third-party payment kills price discipline. Nobody at the emergency room asks what the MRI costs because insurance covers it. There's no price signal, no competition. Prices match north forever. So in other words, if you're not understanding this, prices only stay honest when the person paying feels the price and can walk away. To give you a classic example, if I go to my dentist on Friday and I don't have insurance and the dentist says to me, hey, it's going to cost you $100 to fix a cavity. I wish it only costed $100 to fix a cavity. Thank God I don't have too many cavities. I haven't actually had any cavities in the last few years. But let's say it costs $100 to fix a cavity. And I'm like, geez, that's too expensive. Let me try another dentist. And I find another dentist that can do the exact same job for $80. I'm going to take my money and go to that other dentist and save myself $20. But in that system where nobody has paid for insurance, macroeconomics says that everyone in that society is going to go to the guy who offers cavity fixes for $80. He is offering the exact same service at a lower price point, and he is outcompeting the other dentist that has a $100 price point. And so the economy is able to find the best price, and maybe that $100 guy is like, oh geez, I got to cut back my costs. I've got to deliver a better product. Maybe I got to improve the office. Maybe I have to improve the customer experience to make it actually worth $100. But that whole system and that way of operating doesn't exist when healthcare, or let's say dental care, is free and the government's just going to pay for it. The guy charging $100 is going to say, well, it's $100, but you don't actually have to pay for it. The government is subsidizing it. And then next year, the dentist might say, well, it doesn't really cost me $100 anymore to provide this service. It actually costs me $120. So, but your insurance covers it, so it doesn't really matter. The consumer doesn't care that it costs $120 now because the insurance is still going to cover it. And eventually over time, it's going to cost you $300 to fix a cavity at the dentist. And that's where you see this inflation start to happen. It's sort of artificially produced, and not because any input cost rose that much. Now, I want to just put an asterisk. Obviously, over the course of the last 20 years, the wages have gone up, rents have gone up, various input costs to having a dental office have gone up. I'm just using the dentist thing as an example. So yes, naturally, the cost of getting a cavity fixed or some other service at the dentist is going to go up, but not to the extent that it has, like this graph is showing you. Some of the inflation figures in this graph, I'm willing to bet that 60 to 80% of the inflation you see in some of these sectors that have heavy government involvement and subsidies is a direct result of the free hand of macroeconomics not being allowed to work itself out. And I'm not trying to say that all regulations are bad. I think there are a lot of good things the government tries to do. There are also a lot of bad things that the government tries to do. But there are some things that they attempt to do for the betterment of people. What I'm trying to say is when you pump subsidized demand into a supply that's fixed or restricted, price is going to go up every single time. You're going to create this artificial inflation over time. So I told you I wasn't going to spend too much time on that point. I feel like I definitely got into the weeds on the dentist example for sure. But I'm going to move on to, and I hope that was clear actually. If it wasn't clear, please feel free to leave a comment and ask more questions. It's a topic I'm pretty passionate about. But yeah, we're going to move on to the next topic, and it sort of ties in well with the last one. I recently engaged in a discussion with somebody about housing affordability, and it was interesting that this week I got a piece. Some of the charts I'm going to post here are not my own. They're from a David Rosenberg piece that I had the privilege of reading. He's a very smart individual and posts some really, really interesting things sometimes. So I was really lucky to read that and go through it in detail. And some of the things he discusses about housing affordability I thought were very interesting, and I wanted to discuss on this episode of the podcast. So here's my one-liner to start. I think a whole generation, i.e. my generation, was promised the notion that if you worked hard, you went to school, and you got a job, you were effectively promised a house at some point in the future once you got married, had kids, blah, 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 blah. The same way that it did for anyone in my generation's parents. And I'm here to tell you that the math has sort of quietly made that a fable. It's a bit of a lie. And no amount of massaging the numbers really changes the arithmetic. The consumer and the people my age, the consumers, are in a really tapped out position. I'm going to give you a couple statistics to sort of illustrate that point. Walmart posted $700 billion in revenue. They announced that they're cutting prices on thousands of goods. Ground beef, 12%, cases of Coke, 33%. I'm just reading them here. Cherries are getting cut in half. Its competitors will be forced to follow, obviously, or they're going to lose all of their customers because everyone's going to be ripping their cars down to Walmart to buy all of their cheap goods. Pawn shops are in a bull market right now. Secondhand and consignment demand is absolutely surging. The labor market is quietly shifting toward people holding multiple jobs to make ends meet. And so, in other words, when the biggest discounter in the country is slashing prices and pawn shops are booming, and you add on top of the fact that there's a ton of people looking for a second job or already in a second job, that by no means is a strong consumer. People are struggling. So now that we've talked a little bit about the consumer and the precarious position that they find themselves in, maybe 30, 40, 50 years ago, you could have one or two jobs doing whatever, and at some point you'd be able to afford a house. But now let's talk about the housing affordability. I'm going to put a housing affordability index on the screen just so you can understand where we're at. The gauge here is sort of a reading over 100 means more affordable, and it collapsed after 2021 and is basically sitting near the lows of the entire 2005 to 2026 period, well below the long run average. And that sort of period also captures the period of the great financial crisis where there was a lot of housing struggle. Homeowner affordability is roughly 30% more stretched than it was 20 years ago. Median existing home prices are $430,000. That's in the US. And to qualify for a first time mortgage, you probably need about $93,000 to $100,000 for that down payment. And income for that first time buyer on average is 72,000. That's income for a whole year. So you would have to take your whole income for the year and some just for the down payment on that house. So the typical first time home buyer just does not make enough. You would have to cut your costs to effectively zero and then save for not just 12 months, but let's say 14, 15 months just to have the money for that down payment. And to make matters worse, this was mentioned in the Rosenberg piece and really hit me when I read it. I want to make sure that I get the numbers correct, so I'm going to read them off the screen here. Almost half of US adults under 30 have moved back home with their parents. That's up 12 percentage points from 2019, which is only 7 years ago. Nearly a third of these adult kids are 25 or older. So my age, I'm 26. 55% of those individuals who have moved back have said it's out of financial necessity. Those folks are carrying a share of $1.7 trillion in student debt that no longer gets government support. Delinquencies are pushing past 10%. And a lot of these figures I provided apply to the US, but funnily enough, Rosenberg mentions in his notes some stuff about Canada. So I'm going to read some of the things he says there. Among first-time buyers who bought in the last 5 years, 37% have buyer's remorse. 2/3 are anxious about their mortgage reset. Over half are already struggling to make minimum payments. So the facade that we've been sold, just to paint the picture for you, our parents bought homes at 2 to 3 times, a single person's income. Today, it takes two strong incomes plus help from the bank of mom and dad or wherever else you can get money. And even then, the qualifying math doesn't really add up. It becomes very difficult in this day and age to own a home. Wages have gone up 131% since 2000, but the important stuff like housing, healthcare, education went up far faster, as we saw in the last segment on that graph that I posted. So let me tie it all back together here. I don't say any of this to spook anyone or be this doomer guy who's like, you're never going to own a home. I think the message here is you got to lock in, you got to focus, bootstrap, and something that Kevin O'Leary said recently that he got a lot of flack for about people earning $70,000 a year shouldn't be having a $28 lunch. To some degree, I have to agree with him. Am I going to go hardline and say you should never eat out? You should never spend a single dollar on anything that's not necessary for your survival? I'm not going to say that because we are on this planet one time, and enjoying some small things in life every now and again, celebrating certain things in life is important for your well-being, for your mental health, but keep it within a level that's manageable. Save your money. Make sure you're investing in your TFSA, your FHSA, your 401k, your Roth, whatever, government accounts that you have that maybe have some tax break. Be responsible with your money. It is a very difficult housing market. And although prices, at least in Canada and some parts of the US, have come down a little bit, there's a lot of immigration to these countries. These are some of the greatest countries in the world, and there will never stop being immigration to these countries. And if housing supply doesn't come online, I know there's a lot of projects ongoing about bringing housing supply online. All right, this episode is running long. We've done a lot of boring macroeconomic stuff. I'm gonna now talk about some of the quick twitch muscle stuff. Let's talk about SPCX. SpaceX. So here's the setup. The IPO, June 12th, they priced the stock at 135. On IPO day, it opened at 150. I don't know if you remember, the stock traded to over 200. There was a ton of buyers on the first day. And today, the stock was at 140. So officially, anyone who had a market on open order to buy on the first day because they thought 150 was still a viable price, they are officially underwater. The people who participated in the IPO at 135 are not underwater yet, but we're getting darn close. On July 7th, SpaceX got the fast track into the NASDAQ 100, which is going to force roughly $4.3 billion in buying to include it in the index. And even on that positive news, the stock continues to fall precipitously. So basically, I think what you're seeing here is there's an overwhelming amount of sellers on something. I think the stock issued on IPO day was roughly 5% of the float. When you get good news like that you're going to be added to an index, fast-tracked into one of the biggest indexes in the world, it should be pretty positive news and should have ripped the stock. The thing's got a beta of 7.5. Trades like a meme stock. Like, that thing should have squeezed on that news. But the fact that it traded down, there are some legitimate worried sellers out there that are overwhelming that passive bid to enter the NASDAQ. Now let's talk a little bit about the interesting lockup scenario around SpaceX. So today's tradable float in the market is about 640 million shares. If that's correct, I'm just reading that over there. Total shares that become eligible to sell over the next 14 months, 12 billion shares. I'm going to say those two numbers again. Currently, there's 640 million shares out there, but after all the lockups expire over the next 14 months, there will be 12 billion, not million, 12 billion shares eligible to trade. That's about 19 times the current floats that could get sold. I'm not saying it's going to get sold. For example, Elon owns a ton of the company. He's not going to start just dumping like a typhoon his stock out into the open market, but there are a lot of other holders who, when their lockup expiries, they're going to take their wins and sell the stock. I'm going to put a little chart here that shows timeline and how much stock is getting released after lockups on that timeline, just so you can sort of visualize what's going on. And I just want to say it again. I want to be very precise about my wording. This is eligible to sell. It doesn't mean it's going to get sold. It doesn't mean 12 billion shares are going to get sold and this thing is going to go to $5. It's just that it's eligible to be sold. If the person after lockup wants to sell their shares, they have every right to. But the overhang, I think, caps the stock a little bit. Every rally is going to have a new tranche of sellable stock. So the reason I bring this up, there was a ton of sell-side banks that initiated their research on SpaceX after the 25-day quiet period ended. So that was officially July 7th. At the time of this recording, it's July 8th. So yesterday, a ton of banks initiated buys on SpaceX with some astronomical price targets. I'm going to call out Raymond James quickly on their $800 price target. I think it's absolutely ridiculous, astronomical, and you're doing your clients a disservice by slapping an $800 price target on that stock. I know I don't usually call out firms on here, but I did feel like I needed to call out that one. Everyone else was sort of in the neighborhood of realistic. I'm looking here, UBS at 210, Deutsche Bank 255, B of A 235, JP Morgan 225, but Raymond James at 800, initiating at a strong buy is absolutely bonkers to me. If they end up being right, I will post a video and admit that I was wrong. I'm not afraid to do that. But for this stock to climb to those levels, demand has to swallow enormous amounts of stock over the next few months. So if I were to attach a visual to it, it's like a garden hose trying to swallow like a tsunami of water. I'm not saying all of the tsunami water is going to hit land and reach it to the garden hose, because some of those shares are not sellable. Some of those shares are not going to get sold, i.e. Elon's stock, when his lockup expires. But I think naturally you can assume of the 12 billion shares that become sellable over the next 14 months, let's place a conservative number on it. Let's say 30% of it gets sold. That's still a massive multiple of what's currently out there. I just want to say on the Raymond James thing, a $800 price target places a $10.5 trillion valuation on a company that's only traded for 4 weeks. That would make it the most valuable company on earth in history. And they said something about a $30 trillion total addressable market. Like, these numbers are just like You just plucked him, placed him, plucked him, and placed him in the report. I swear to God. I don't want to, crud all over this company. Yeah, I think very innovative CEO. I think what they're trying to do is very admirable. Elon has proved time and time again that he knows what he's doing and he is a extremely hard worker. But none of that changes the fact that some of these economics don't add up and that some of these sell side firms, who, by the way, helped underwrite the deal and have sort of a conflict of interest, are placing really, really crazy price targets on this stock, setting expectations for investors, I think way too high. So anyway, that was a long episode. I hope you got a lot of value from that. I know I talked a lot about macroeconomic stuff that some people maybe don't really care to hear, or maybe they're too afraid to hear, but I think it needs to be discussed. It helps illustrate some of the things that we see in the stock market really well. I've always said to everyone that the most important part of my university education wasn't learning about derivatives, wasn't learning about application to financial markets, it wasn't learning about how to price or value a stock. It was about learning at macroeconomics and microeconomics and how companies functioned within each other, within themselves, and how companies functioned with other companies within the economy, the broader economy, and the global economy. So I think it's important to touch on that stuff. Anywho, that's the end of the episode. That's all I've got to say. Please make sure you like, follow, subscribe, all that nonsense on YouTube, TikTok, Instagram. I do the short forms all the time. I've started to get more active on the shorts recently as I've had a little more time on my hands. And as I've said at the beginning of the episode, my name is Alex Ivanovich. This is That Makes Zero Sense, the podcast. Thank you so much for listening. I hope you have a fantastic Friday and an even better weekend. Take care, and I will catch you on the next episode. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.